Okay, let me talk about the efficient market hypothesis. Um, so basically, it says the market is efficient. That's the conclusion. So for any of you take any econ classes, you should know that they all talk about efficient market, and then capital asset pricing model says we assume the market is efficient, right? But this is just a hypothesis, and this guy won Nobel Prize for economics because of that. So this is one chart showing that this is announced data. A company has some good news, right? Then when this is the time when they announce it, the stock price jumped directly, like to the high level, to reflect the good news. However, we do see some trader here. But if the market is efficient, okay, it should go like this, like a straight line. Okay, there should be no dot points or transaction here. It seems they have some insider information. So you just said why they think the market is efficient. They just think that they try to argue that stock price change are random. Okay, so every day, every second, the stock price is just unpredictable. It just moves from some place randomly to other level. Okay, why? This is from physics. Okay, so there are a lot of theory in physics, especially when they talk about energy. They have some calculations for that, and then they borrow that and then try to apply that into finance. Certainly this is not right? There's no way stock price move randomly. It cannot go below zero, right? So they didn't quit trying. They changed the model somehow to still implement the randomness into it. And so the whole idea is price of security fully reflect available information or news, right? Reflect all news. And then news are unpredictable, right? You don't know. You kind of can guess whether it's good news or bad news, but 50% chance. So anything you know is not news anymore. Anything new is called news. Okay, so that's why. And then the news will be incorporated into price, right? That's why the price is also unpredictable. Whenever it's unpredictable, you move randomly, right? That's what they say. Do you believe it? It is an interesting idea, okay, but certainly there are a lot of issues related. Right? However, I do believe it. We will talk about it, okay? What I believe. So they started from here. Okay, they think the market is very efficient. Stock price reflects all relevant information, including insider information. Is that true? That's certainly not true, right? So insider information, we all see insiders got put into jail because of insider trading. So that's no way insiders cannot make money if we have no regulations. Or even if we have regulations, they still do those, right? And then they say, let's just change it a little bit. Stock price already reflects all public information. This is all accounting information, okay? Anything public, including accounting information. But Warren Buffett, right, argues for fundamental investing, which is using accounting statement. If this is true, those people will make no more money than you do, right? And then they have another form. It's called a weak form. Stock price reflects all historical information, okay? So this is more acceptable, okay? This has some argument, and then this 100% wrong, okay? This is probably okay, and people are still doing value investing, and some still believe that. So technical analysis, what do? They just look at historical trend, right, to use a price pattern to predict the future. And then fundamental analysis, use financial accounting information, right? So when the market is in a weak form of efficiency, technical analysis such as charting should not result in superior profit. If the market is in semi-strong form, fundamental analysis should not result in consistent superior results either. So whatever, as long as you believe market is kind of efficient, okay, technical analysis has no places, okay. It shouldn't work at all, even when the market is in a weak form. And then the fundamental analysis, okay, fundamental analysis will be useful only when the market is in the weak form. Okay, is that a little bit confusing? It is a little bit confusing. Okay, so basically we see those people trading all the time, right, using technical analysis, looking at like historical trend, like resistance level, supporting level. I think even CFA tests those really weird things. And they just say, if you kind of think that the market is in, we have three forms, right? Three types, generally agreed types. If the market is in any kind of efficient types, you should not use any technical analysis. Okay. Technical analysis should not even exist because the market is kind of efficient. That's what they say. Okay, is that making sense? Okay, and then they say if you want to analyze the financial accounting, right, and then use those to predict the stock price, it will only be useful when the market is in a weak form. Okay, so why they have three forms? Because people don't agree with each other. So that's pretty straightforward. Some people think it's very strong form. Some people think maybe it's not necessarily, right. Overall, people agree that market is kind of efficient. Okay, so that's why passive investments those days, okay, are increasing, like Vanguard, right? At Charlotte right now, like Vanguard has like 5 trillion already as under management. A lot of them are passive because they just believe the market is efficient and then they have low cost. That kind of creates some higher systematic risk overall. I wouldn't argue with a lot of evidence. Implications, okay, active versus passive, I talk about it, right? And then a lot of research shows active management, they don't do well. But portfolio, this is important, okay, especially for CFP board, registered programs. Portfolio management is still necessary even if market is in a strong form, because as financial advisors, we can always look at investor risk level and then their tax situations, and then ask them, help them diversify. Okay, and also when they have some cash inflow like coupon payments, how do we reinvest those? Is also something we can contribute. So our market is really efficient. There are enough evidence that market is efficient enough. It's called arbitrage, right? Even if the market is not efficient, you cannot make free money. So that's what it says. Even you have some superiority, okay, you cannot possibly make a significant profit, and then the profit you make will probably be equivalent to the cost you have. So that's why you cannot have any arbitrage opportunities. Let me move forward to Excel and then show you guys what it looks like. I pulled data from, again, Yahoo Finance, right, for Apple stock, and then starting from 2000, okay, and then those are the adjusted close, because this stock split several times because the price is so high. Those are their daily return, right? Then use that, I calculate their arithmetic return, and then their standard deviation and their volatility, right? This is just geometric, just show you guys if you are interested, geometric return calculation, annualize that. And then we can start from the latest price, right, which is today's price. And then you can simulate, okay, this is when this is where random walk comes in, okay, just randomly, okay, draw a number, assume that your Apple stock is going to follow the normal distribution with the average of this, with standard deviation of that. That's what's going on here, okay, just randomly draw a percentile from that distribution, and then that will give you a return, right? And then this will be adjusted, right? Like whenever I change something, right, whenever I try to save it, you see that we have a lot of different scenarios, right? The stock price within 250, which is probably a year, like 250 days. It can be like this, or it can be like this, right? It can go really bad, or it can be like very flat, or it can go up and then come back, right? Just a lot of scenarios. It becomes clear to see if you look at, I have it open already using Python, right? So again, we did the same thing, just like what I did. Okay, we also pull from Yahoo Finance. You guys can see this line of code. We'll get all the data from Yahoo Finance, just one line, and then it calculates the return and volatility, right? And then we are going to use that to draw the simulations. So this is one simulation, just like we did using Excel. However, using Python, this is just a little bit too much, right? Let me just do 100. Probably easier to see. So we can do 100 is also too much. Let's just do 50, right? And do 50 at a time, right? Just shows you you can be very random. It's called a Monte Carlo simulation. Okay, I hope this helps. Let me know if you have any questions.